without further ado, thank you so much, everyone, for joining today. We promised you three of our most favorite Xoogler VCs. Unfortunately, Barish was got really sick this weekend, so he could not join us. But we have Eric and Manu, and then we are going to talk about a little bit personal, a little bit based on their experience. So ideally, my goal is after this session, we have some understanding of, what goes in the mind of the VCs and from their experience, what they see frequently, who are the winning teams that reach out to them, and what are the biggest mistakes that some other founders might make. And then we will have, hopefully at the end, a few minutes for Q&A. So I'm going to have like a rapid fire questions, really quick, a few questions from Manu and Eric. So like I will ask you and you could, start answering one by one, and then we will jump into your investment thesis. All good?
Sounds good.
Okay. So then maybe Manu, you start. When did you raise your first fund and how many rounds?
Actually, do you mind just make a quick check? I would love for Manu to briefly introduce himself, like who he is and his background and Google experience. I'll do the same. Yeah. I realized I forgot you were just jumping to questions. I should have given you that feedback earlier. Like, we should probably say who we are.
Yeah. I was like trying to get back to it after, but yeah, we can start with that. Go for it.
Sure. Go ahead, Manu.
Thank you. Thanks, Eric. So I was at Google from 2004 to 2009, roughly. I worked on Gmail, Calendar, Orchid, then DoubleClick, and a few other things in between. I think I forget after so many bottles of wine. And then prior to that, I've done a couple of startups. My background, I had done a biochemistry, molecular bio with a minor in CS. But the scientific approach actually helped me to actually become a better product manager, I think, to be able to phrase problems. And I think it's the same thing, to be able to understand what the problems are, because the solutions are best done by the engineers and the people who build them. But understanding how to frame problems, I think, was very useful as a product manager and also now as a VC as well. And I became an LP in this fund while I was at Google. And then eventually, after 5 years of them saying to join, I finally joined them in 2010. I left Google in 2009. So anyways, that's my background, and the rest is on LinkedIn. I'll let Eric take over.
Yeah, hi, Eric Rosenblum. I'm managing partner with Foothill Ventures. I was at Google from 2008 to 2012. My first 2 years, I was a director in the biz ops and strategy team, and then I became a director on commerce PM team. I did Google Offers and also worked on payments. And after that, I left for another startup called Drawbridge. And Drawbridge is cross-device identity that was founded by the chief data scientist for AdMob. And we were backed by Sequoia and Kleiner Perkins. So I learned a lot about seed stage investing really from them. And that company exited to LinkedIn. And then I worked at another big data analytics company called Palantir, where I did product management for cybersecurity, fraud, and anti-money laundering before becoming a VC full-time starting in 2017. My personal background, I did economics and then was a consultant at the very beginning of my career. And yeah, that's it. So sorry to have hijacked the process, but
no. I appreciate that. Yeah, I appreciate that. Okay, so let's jump in. Then Eric, maybe you start answering. So when did you raise your first fund, and how many rounds have you raised so far?
Yeah, so we're on fund 3 right now. Our first fund is from 2017, but we came out of an angel fund. So before I joined, my partners were all part of something called TEAK Angel Fund, which stands for Tsinghua Entrepreneur Executive Club. As it sounds, two people from Tsinghua University in China who came to the States mostly for their PhDs and started an angel fund from 2011. So I actually knew them because my chief engineer at Google was a guy named Richard Liu. Some of you might know him. He was one of the lead engineers for payments. And so I became an LP of the fund through him, and then joined full-time after I left Palantir. And so the current fund, Fund 1 was 2017, 50 million. Fund 2 is 100 million. Fund 3 is also 100 million.
Thank you. So very short answers, Manu. So when did you raise your first fund and how many rounds you have raised so far?
So first fund 2008. I wasn't part of the fund. I joined halfway through that fund. We're on fund 4. We're raising fund 4 in the moment, and our funds are typically between 50 to 150 million.
Thank you. And Eric, so what's your average check size and how many checks do you write per year?
$1.5 million, and we write 20 checks per year.
And Manu, your check
So,
size?
so our check sizes are $500,000, but we're able to write a $3 million check. And so we have a very unique strategy where we actually have a second fund that is actually we manage and own, but we don't charge fees and carry. And so we're able to leverage, and then in future rounds, we get all the pro rata rights. So we have a very hybrid sort of model. So anyways, that gives us the strength to do larger checks.
Okay. And Eric, what do you invest in?
So we're normally slotted into deep tech, but we're broad. So 50% in software, 30% in frontier tech, 20% in life sciences. And just to give some examples, in software, it's usually AI and AI infrastructure. In frontier tech, it's largely around energy and semiconductors. And in medical or life sciences, it's largely around neurobiology. But they're all kind of connected largely through AI.
Perfect. And Manu, what do you invest in?
Yeah, similar. So we don't have a thesis in terms of category. We sort of don't do anything that has regulatory requirements. So anything with FDA typically. And we try to stay away from hardware, but everything else, whether it's consumer, enterprise, we do them all. First 2 funds, 50-50 is almost was consumer. I think it's more 75% enterprise now and 25% consumer.
Thank you. And Eric, what do you not invest in?
Things that don't have any technical moats. So it's generally, we don't invest in anything consumer. We don't invest in marketplaces. We don't like crypto, although we're not really opposed to it, but we just haven't. It's not an area of specialization. And we tend to avoid any kind of national security or defense tech. But again, it's not a core, it's not a hard no, but it's not a focus.
And Manu, what do you not invest in?
Well, I sort of mentioned we don't like to do anything regulatory or typical hardware, but we never said never. We did a space tech company. And the other part we do is we invest in the US and India. So about half my portfolio companies are out of India. So very similar to Eric's focus on the universities out of China. We have very strong sort of partnerships with universities in India. And then whether the founders started in India and then and then we fund them there, or they moved here, went to college here, worked here, and then started a company, it doesn't matter to us. We sort of catch them on both sides.
Yeah.
So, yeah, actually, I should have specified. So we only invest in North America currently, but you're absolutely right, Manu, that a large portion of our founders emigrated here from China, India, Turkey, Iran, etc. So 85% of our teams are led by immigrant founders, but only in North America.
Yeah, I mean, as that song from Hamilton, immigrants get the shit done.
Yes, that's very true. Very true. And then how often do you do follow-up investments? Is that part of your strategy? Manu, I know you have the whole vehicle set up. Maybe talk 3 sentences about that for us.
Yeah, so the way we structured our fund now, fund 3 and 4, we do about 25% of our investment is in the first check, right? And 75% is actually saved for follow-on investments because of this super pro rata strategy that we have. So yeah, most funds will do 75% or 60% in the first check and then do otherwise. And so that's our strategy. We always follow through all the way to the end.
So how many, in your previous rounds, how many of your initial investments, let's say if you invested in 20, how many of them did you end up?
So roughly our graduation rate from seed to Series A is about 60%, right? Of those, we will choose which one we'll do pro rata versus super pro rata. So, right, and 40% early failure, so that you don't have to re-up and to reallocate capital. And then there's about 1 in 10, maybe 2 in 10, that will continue to sort of have the final exits, right? That's the big exits, and then there's the smaller ones that sort of exit for 3 or 4 times or 2 times or you get your cash back. So that's typically sort of the bell curve that we look at.
Perfect. And Eric, what about you? Like, how often do you do follow-up? What's your strategy?
Yeah, so the general funding cycle is 18 months. So when you're a founder, you will expect to raise from between your seed and your A is 18-month cycle, another 18 months to the B, et cetera, is kind of the way we operate. We maximize the first check. So 70% of our funds go out with first check. And so we're doubling down on who we think the large percent of winners are. So similar to Manu, all funds, 10% of the fund returns, more than 80% of what we'll get back. And then the next 10% will account for about 15% or even maybe 19%. Like the vast majority comes in the first 20%. And so you're trying to double down on those. We do also have a bit of a hybrid structure where our LPs, the big ones, have co-investment rights. And so they'll be writing the checks from Series B onward. So we're what I would call a two-check fund directly. We write normally the seed, and then for the top 30% of the fund, we'll write an A, and then we'll hand the baton off to our LPs.
Awesome. Thank you. So I would like to now spend a little time on the investment thesis. That is like less spoken about, but I think is critically important for founders who want to raise funds to really understand what is the investment thesis. And because also VC funds, like founders of startups, have to really work on their thesis, their hypothesis, how would they invest, and that's how they raise their own funds, right? So it's a very, very critically important topic for success of a VC. So Eric, what is your investment thesis?
Yeah, so we think that the world is going through some very large technical changes right now, and that's not always the case in venture. So there were a lot of fortunes made in things like ad tech or e-commerce or mobile apps that weren't that technical, but we think there's a few big technical shifts happening. So deep learning is one. Energy transition, so the transition to electric vehicles, for example, or grid storage, the transition to automation and robotics. So there's a few of these that are very large. And then there's supporting technologies, like all of our datacom infrastructure needs to get rebuilt as a result of AI. So we basically kind of have some macro theses that a bunch of mini themes hang on. And we talk a lot about these big changes that are happening. So we do look for deals in these areas. We don't filter though. We don't say, this is so, we are open to learning about other areas and seeing if this will fit one of the areas that we're already interested in, but we simply can't know about everything. And so our thesis is specifically big tech change happening, that most VCs are ill-equipped to invest in these technical changes at the seed round because most VCs want to wait till technical risk has disappeared and they'll invest at market risk. And finally, that the people who are starting these companies are generally very technical and they're not good at presenting. And that there's an undervaluation against the founders of these kinds of companies at the earliest stage. They catch up later once there's validation, but the early stage, they often struggle. And so that's kind of our sweet spot.
Wonderful, wonderful. And Manu, what is your thesis?
Yeah, I think Eric could speak for my thesis as well. It's very similar. And at the early pre-seed seed stage that we play in as well, you can't sort of sit back and have thesis build like the later stage funds do, right? And so you have to take risk up front. We're focused on the founders. The founders come in and prep us. Like, for example, we said for the longest time we will never do a hardware company. And then you had a space tech company, this founder just blew our minds away and we took the risk, right? And now this company just got a $100 million contract recently. So it works, right? And so we focus on the founder. Our job is to actually, we call ourselves dream merchants. You have a dream and I'll buy it. You can't go somewhere else to sell the dream. And the later stage VCs want facts and details. And I think facts and details come in the way of a good story in a dream, right? And so we buy the dream and we're helping them going from good technical founders into converting them into good CEOs, founder CEOs by the time they raise the next round. So we sort of pride ourselves on being coaches, trying to get them across that stage. So no thesis. I mean, we like to be surprised. We want people to impress, and for us to learn something different as well in the process.
Thank you, thank you. So then I would like to, in the next conversation, this next segment is about the deal flows and how you make your decisions. So actually, how do you get your deal flows? Where do they come from generally for you? Eric?
Yeah, so it's evolved a bit over time. I think all small firms start out the same way, which is you invest in who you know. And so, if you are at Google and now you do a VC, you're likely to meet a lot of Googlers and hear about their ideas. And then eventually you just run out of friends and you have to figure out how to build a more sustained deal flow. So for us, the kind of core has always been relationships with certain universities and labs. So we're very close with the optics group at Harvard, for example, and the energy and chemistry groups at MIT and UCSD. So that's number one. And then, so basically constant, tabs on the principal investigators in various regions and various schools. Then number two is there are other VCs that overlap with us a lot. And so whenever TDK Ventures sees anything that has to do with energy, they'll always call me and I'll always call them. And you start to form a trusted group of other VCs that you like to work with. And so that's the second area. But then third, all of us were product managers and engineers. And so we're probably more comfortable building systems than like going out to conferences or trying to show up at parties. We're not very comfortable with that. And so we've built a system that profile I mentioned, that if you went to a top school in Iran or China or India, and now you've gone to a top graduate program here, if you did a query on all those people and say LinkedIn, you'd find that there's something like 170,000 profiles of that into PhD programs that are currently active. And you can start to market to them at top of the funnel, like, hey, congratulations on going into the chemistry program at MIT. By the way, we've backed person A, person B, person C. If you're ever interested in how a technical founder does a startup, here's some stuff we've written. And we market to them at each stage of that funnel. So when they finally exit postdoc and now they've joined Google, whatever, AI research, we say, hey, when you're ready to leave Google, we're here, call us. And so it does help to have a kind of founder. So to Manu's point, we're all about founders at the early stage. And so if you can identify a target founder type, you can build a system to start to try to identify them. So to answer your question directly, our biggest source is number one, relationships with universities. Number two, other VCs. But number three is this automated system that actually is growing very quickly and will probably be our number one source of deals, probably within a year. We just started doing this about 9 months ago. And just the scale of it is
Closed on that right now so far.
We've done 4 deals that were sourced through this channel. Yeah.
Amazing. So Manu, what is your deal sourcing and how does that work for you?
Yeah, I think it's the same things that Eric mentioned as well, but I'll add a couple more because we just a little bit more had more vintages behind us. But I teach at Berkeley in Columbia, and that allows us to get deal sourcing there, similar to university. My partner does at IIT Bombay. We funded a couple of universities as well, to help do the same thing. And the other thing we really believe in, have been doing it for 2 decades almost, is teach the teachers, right? And so build the ecosystem. You have people build before us, the angels. So we've actually supported a lot of angel communities, actually mentoring people who become an angel. I wrote an article a couple of years ago as well about, how should you become an angel investor, right? Should you put money into a VC firm like us and be an LP, or should you become an angel investor, and what requires? So being just very transparent across the system. Our average, so we're also very popular on social media. My partner has a large following of a few 100,000 people, and he typically gets over 1 million views per post he does every week. So that's a strong funnel. So our problem has become not sourcing, it's actually filtering. So our deal flow is 3,000. It's actually in the pace to go to 5,000 per year. It's just physically impossible, and we don't believe in analysts. I want to be the first port of call between me and the founder, right? Whether we're selecting the company, to helping them, mentoring them, and helping them exit. So we want, the founders are getting one of us to actually help them. So we've actually been building AI tools, sort of co-pilots that have actually been very useful as of recent. So everything from sourcing to helping them, the founders, find funding every 18 months. So matchmaking with other VCs, and then also the exiting part and helping them find customers as well. So So we've been using some of these tools very effectively. And I had pulled my old data scientist that used to work for me at Google to come work for me full time. He was a professor and PhD for AI and data science, and now, as of 9 months ago, he's been working with us full time.
Good catch.
So we had to start dog fooding things we invested in as well. So it's just very hard because when I first started out to now, the deal flow has gone up by 10x, right?
Yeah.
And that's just the number of startups have gone up. So you physically just can't go through everything. Right?
Wonderful. So the follow-up questions is from your perspective as experienced VCs, what does the best practice fundraising process looks like at, let's say, seed stage, very early on? Like how would the founders present themselves? What signs do you see that they really have a strategy, they're doing it the right way?
Yeah. So there's a few things. I'll put another link in the chat because I actually wrote up like what I think is a best practice and published as a blog. Internally, actually, I built like a whole, or our team built like a playbook for all of our companies. So literally all the templates, all the forms they need to use, all the investor lists and whatnot is a big point of leverage for us as a VC because it's very hard to do like that much one-on-one coaching with all the companies in the portfolio. So we try to automate as much as possible. But in brief, the number one thing, which is annoying for entrepreneurs, but there's a reason for this, is you really should get warm intros. So you start with building your list and figuring out what investors invest in what areas and what stage, because a lot of time is just wasted trying to hit up investors that just are never going to invest in you. So they're either the wrong stage, wrong geographic focus, wrong sector focus. And there's lots of free tools out there like signal.nfx.com or others, where they're just lists of investors and what we invest in. And they're pretty accurate. That signal.nfx is crowdsourced. So I inputted the things I like. But there are others that like PitchBook or Crunchbase, where even with the free versions, like with Crunchbase, you can see what people have invested in. And it's very unlikely that if they have never made investment in your area, you'll be the first. It's much more likely if you can see they have a cluster, that it's at least within their cluster. And then once you have your list, now you have a universe of people that everyone who worked at Google can get to almost anybody within 1 degree of separation. That's the beauty of being a Xoogler, is that there is literally nobody in tech that you couldn't find somebody to introduce. And just one word about that, and then I'll stop talking because I have a lot more advice, but I would love to hear from Manu on the first thing. Is I think of it as first the funnel. It's like you have to get someone to take you seriously first. And the reality, unfortunately, is that the cold email is very unlikely to get much attention. And some VCs will say, well, it is a sign the founder just doesn't know how to do basic sales. Like all sales is better when it's a warm intro. And if you don't have the wherewithal to find at least one person who knows me and knows you, then it's not a good sign for you in the future. And so I'd say my response rate to cold intros, meaning not only responding, because actually I respond to all of them, and usually it's no, but my acceptance rate of cold intros is probably below 5%. And so we occasionally say, yeah, we'll take the meeting, but it's rare.
Thank you. So Manu, what are the signals for you that they're doing it right?
Yeah, there's a lot of signal can go both ways. I think to all the things that Eric mentioned, but really spending time, like if you were to look for a job, right? I always recommend people spend 20, 30, 40 hours really researching about the company before you apply to work there. Because it's not just getting a job interview and a job, because you may be miserable later on. You may realize it's the wrong fit for you. And if you're going to spend 40, 50 hours a week working somewhere else, you should actually spend some time researching where you're going to go. So on the same note, research on the VCs you're going to want to try to bring on board, really understand, where they come from, and if that person's going to be on your board for the next 3, 4, 5 years, you better not have an asshole on your board, right? So I think I always think like a founder as well, and have the same advice back to my founders, right? So make sure it's the right fit, because so many things can go wrong into with your company. You want to make sure the things you can control, try to sort of manage it. And it's not just about tech is important, but it's when you talk to a VC, unlike a corporate or somewhere else, you have to be able to explain how do you build all functions. So if you're scaling the company, I'm going to scale 2x, 3x year over year. But as a founder, you need to scale faster than your company is scaling, otherwise you become obsolete. So we're looking for founders that have very strong sort of ongoing learning ability. So we look at 10 different traits. We actually publish these traits on our website. So one of us is always sort of testing, trying to figure out whether this person has a sense of intellectual honesty. Are they rebellious? Are they fair? Are they equal? So all these different pieces. You don't have to have all 10 to get our investment. There are things that your mom or dad should have taught you. That's too late for us by the time you come here. But a lot of times people are doing a startup just because their friends are doing it. It's not the right reasons, and it's really goddamn hard to be a founder, right? It's the most loneliest job you'll ever have. Your spouse or your parents are telling you shouldn't do it, right? It's easier just to stay at Google or somewhere else. But if you have that penchant to be a founder, you better have the grit, and you need to surround yourself with people who can actually support you, right? So we look for those. It's always the qualitative parts that really make a difference in long-term equity value.
Wonderful. Eric,
Yeah,
do you want to
yeah, I'll add some things. So there's stuff that is done under the hood that we may not see, but I think is really important. And so the best founders at this, when they are running the process, they do run it like a process. They have their Google Sheet or whatever CRM tool they're using. They have us ranked, and they kind of do this in waves, where wave one are people they know really well that will give them honest feedback. Like, hey, most VCs will, the thing I see about good VCs, they're always super nice. And when I was a founder, I was like, wow, that was the best meeting. And it turned out and that was even the case for more prestigious investors were nicer than less prestigious investors. And I realized later that the smart investors know that there's never any benefit to being a jerk. Because you never know, life's long. There's no reason to be a jerk. Be nice, give some good feedback, but it doesn't mean they're going to invest. And so it's smart for people to have done their run-throughs first with people that are closer to them and are still real investors that can give them real feedback, not just a friend who doesn't invest, because their feedback may be useful, but it's not as valuable as someone who is investing for a living. And so by the time you get to the people that you really care about, that it's an important meeting, it really should go right, you've iterated a bit on the whole story and you've gotten better at it. It is a skill. One thing, I have a few things that may be controversial or maybe my own quirks, and I'll just say them. Manu may or may not disagree. One thing that is kind of a big turnoff to me is if someone spends a lot of the intro meeting interviewing me, and tell me about the value add you provide to your investors, to your portfolio. Tell me about, basically saying why do you have the right to invest in my company? I believe those are really good questions, but it's after we're already now you have 4 or 5 investors who are interested in you, and then the tables turn, and I think that's really great for you to interview us and do reference checks. But in your first meeting, because of the nature of investors and startups, you only have a half hour or 45 minutes to make your case. And if you're going to spend 30 minutes or 40 minutes getting me to make my case, I think some entrepreneurs believe it's showing me that they're not desperate, that they're thinking through all of this, but it actually, to me, just shows they don't really understand the time management involved in this is their shot. And later, if all goes well and you have 5 or 6 investors that really want in, then you should go very deeply on them. Like Manu said, it's a job interview in the end, and you want to make sure you have the best people involved. But first, I think you want to line up, all the job offers, so to speak. You wouldn't walk into a job offer and spend, half of it, making sure they have the right to hire you. You would first try to get the job offer, and then turn around and say, what's the quality of life here? What's the, prospect for promotion? So that's one of the things I've seen go badly, where the startup doesn't quite understand how to use the time that they have and how to run the process effectively. And each step, it changes a little bit. So anyway, just wanted to throw that out as well.
So actually, there's this one question that came to my mind. Um, when you mentioned about look into the portfolio, make sure they have at least made some investment in the field. So sometimes founders have the concerns of like, if they are doing too many investment here, how do I know they're not going to steal my idea and share it with one of like their successful? So what is your advice? What is your strategy on that?
Yeah, information always has, I mean, coming from Google, information just has a way of free flowing anyways. So assume it's going to be happening anyways. I mean, we try really hard not to, share information, and we don't. But, if you have something else in a portfolio now, later, and you're discussing it, it's your pattern recognition you're sharing with the founder. Some of these patterns are based on all the conversations you have, right? So I think you start a conversation with trust, right? You have to sort of, this is why I say do the research on the partner or the fund you're going to be dealing with. If they have a reputation in the market, the reputation's listed somewhere, right? So you should avoid those people. I think 95% of the people are because I can't do this work unless there's trust built there, right? My reputation matters more than any of these things, and so we try really hard to actually do it, and we also put ourselves in the founder's shoes because we've been founders in the past, right? So I don't think it's a big risk. I think it becomes just like anything small, it becomes overblown, and I think it's a minuscule part of your concern.
So a quick
Yeah,
follow-up question. Let me just, Eric, and if you have
yeah, go ahead.
answer that. So how can you actually check for reputation of VCs? Is it just word of mouth, or is there any resource online? Maybe Eric, maybe.
If you're getting referred from somebody, right, I think you sort of get to know this. I think just like, if you were dating and you know the person's a cheat, well, you sort of, there's no online place you go find out if the boy you're gonna date is a cheat, right? But you sort of get a sense. I think it's the same thing. It's not, there's no like a website, like a Glassdoor, where you can say that, this is a reputation. If there is, I'd like to know about it as well.
Yeah. There are a few things. So if you're part of an incubator community, they normally do try to have their internal kind of Yelp for founders or Glassdoor for founders. So if you're part of YC or Neo or any of these accelerators, this is one of the things they add is kind of internal ratings. And it's something we do. Like at this point, after this many years of investing, we've backed like more than 300 companies, and so over time, we do find out who their investors were, and to the extent that there are bad experiences, then we do make that available. But this is assuming you're not already in one of those networks. So first, I violently agree with Manu that entrepreneurs who are super cagey about what they're doing or super worried that the idea will get out, I would never invest in them anyway, because normally what matters is just that their velocity is so high that no one's going to catch them. And so like the great chess players, you know exactly what they're going to do. They're just going to bludgeon you anyway, because they're executing very, very well. And so normally in your pitch deck, there's nothing that falls in the realm of the kinds of insights that are truly a barrier. So for example, if we have a semiconductor company that is pitching us, they're not going to go through their architecture. They're not going to go through things that are truly secret. The idea they have that they're going to focus on AI processing is not a new idea. Tons and tons of people are going to do it. The fact that they're going to pitch to a VC is not going to reveal anything that will give a competitor an actual advantage. And the ones that are overly cagey about this kind of thing raise a flag to me that they just don't really understand that they need to be prioritizing speed versus almost everything else at this stage of their startup journey. But in terms of reputation, I agree also with Manu that ultimately it is trying to get someone from the portfolio that has worked with them. So in terms of getting warm intros, the best warm intro is someone that's a fellow founder. That's hard to get, but that is gold. If you can find a fellow portfolio founder to say, this other person's great, you should see them, that is gold.
Wonderful. And I also agree. Usually my response to that question of how do I trust is like, the idea is dime a dozen, right? It's all matters how you can execute it. And then there's pretty much these days no idea that you are the first person who thinks about it. Probably 20 other people tried. So it really matters. The winner is the best executor.
Yeah, I mean, the old adage, right? Success is 1% inspiration and 99% perspiration. And you want people around you to be helping you, right? And so a good founder is sort of a bully pulpit. They're convincing employees to come join them, VCs to join them, partners, customers. So you're constantly, getting your message out, right? And so the message is out, right? But you have to know what not to share, right? I mean, you're not sort of putting out as Eric mentioned, your architecture or your secret sauce in the market. But you still have to talk. If you can't talk, you'll be the best known secret that nobody knows about, right? And then what's the success, anyways. And so I think you need to balance this with some reality.
Yeah. So
Yeah, one other just one other thing to add around this general topic of the pitch and the pitch meeting. What do you reveal? What do you not reveal? Also a stylistic thing, and this also might be controversial. I don't think all VCs agree with me here, but there's a lot of founders that come in the meeting and be like, hey, I found it good to just talk through my idea, and that'll make it more interactive. And this is, the whiteboard or whatever. I think whiteboard sessions can be super effective. And if you're actually in the room with them and you're a good whiteboard person, it can be great. I think over Zoom, if you're just talking through your idea, it's terrible. And you just have to realize that we're in like kind of these meetings a day, and we're going to retain so little of what you just said. And we just need a visual aid. And then also there are tools. Like I always have Otter running now for 100% of my meetings. And I get a transcript with a screenshot of everything. And then I can talk to the rest of the team and be like, oh, I saw this great founder. Here's everything. And then they're up to speed. They don't have to have another meeting to discuss everything we just discussed. And so I do think founders make a mistake when they're like on a Zoom meeting and think it'll be a better interactive conversation to just talk. Even though it might seem that way, it's just harder for us to retain that information later. And you'll kind of fall away, even though it's tempting. But if you're in the room with them and you're good at whiteboarding, and that's a big if, not many people are that good at it. But if you're really good at doing the real-time whiteboard presentation, by all means, those are great. But don't, believe that you can just talk.
thank you. So if founders, let's say there are a few, like they have CEO, they have CTO, and a couple of other people. Actually, who do you think for that first meeting, who should participate?
To me, I think having the CEO, the main person present is fine, right? I think, if it progresses to the next meeting, having the co-founder, join is actually useful. We like to sort of get to the technical stuff pretty quickly, getting to know the co-founder, who's the person building the things. But the first meeting, I think, is fine with the CEO because, you don't know where this is going to lead to in that first meeting.
Yeah, agreed. Yeah, I completely agree. You don't need to show up with like your whole team. It's, but another another pet peeve. One thing, again, Manu and I are investing in people, and we really do want to know the team's qualifications. A lot of founders, they have a team slide that just has like the pictures and then maybe the logos that this person was at Google, this person was at Meta. I really want to hear about how this team came together, why they're great, why this person is exactly the best co-founder. I do want you to spend time on the people, but it can, because of the nature of the way meetings are run, if you have a bunch of people in the room and everybody has to talk, it just can be like not only distracting but inefficient for the founder. And so it's great for the CEO to be there, but they should be prepared to really talk about why their team is great. And I think that's so critical. But people tend to spend all their time on the technology and the market and competition, and they just have a team slide that goes up. It just has their pictures sometimes, and I feel like they've made a mistake.
Yeah, I couldn't agree more. I think it's sort of a brochure, and I've never seen a company or CEO sort of present that the team was not that great, right? Everybody talks about how great their team is, but really understanding the nuances. Okay, why does these 4 people are the best people for this thing, right? And it's not just you look good on resume. So we recently actually wrote a co-pilot to actually pull data from all the people on the team across the board, sort of pull the data in and actually analyze that information, so that when we do talk to the founder, we can ask very specific questions. Okay, well, you met so and so at Stanford, and what did you work on? Did you have some experience? So then it becomes more of a conversation because now I have a little bit more information rather than if they don't provide it, we're prepared with those questions.
Yeah.
Interesting.
Oh, sorry. Just one more thing that's occurred to me in kind of the basics in terms of fundraising. And it's also, you prompted it by asking turnoffs, my other turnoff. Kind of irrational valuation expectations. And it just sometimes I think is a mark of immaturity. So you should have some idea if you're a pre-seed company or you're a seed company or your Series A company and what that means and what it means in terms of like what you need and why you need this much money and then what it should mean from a valuation standpoint. Like you should have enough homework where you kind of know where you fit. Because otherwise, you're in like a pre-seed company meeting, like we're raising, $15 million to do X. I'm like, you're like 3 people, you just started working. I'm not sure. This doesn't make any sense to me.
So,
Yeah, no, I think that's you need to take your strategy, your PowerPoint slides, and really convert that into your financials. And I think a lot of founders don't do that. Or, for example, I just had an amazing founder that presented. He sent me his financials. I looked it through. He needed like about $3.84 million in for his financing. So I offered a $5 million term sheet, which is added 25% on top, and make sure that there was plenty of money for him to make sure if he made mistakes, he could still get through. So we were sitting in the cafe trying to discuss this, and he's like, no, I actually needed 8 million. And I'm like, well, the financials you sent over to me in the diligence room actually don't show that. So we went over it. And actually, no matter how many times he looked at it in real time, it actually didn't look like it needed more than 4. So he basically shut his laptop down and sort of said, I need to go back and rework this. But he was asking for 8, but his own plan actually showed 4. And he was stuck that he needed to raise 8, right? And he's pitching to other VCs on 8 as well. And so now that deal is breaking apart because it was just so far apart. And now I'm questioning, some of the pieces, right? So I think really making sure you're dotting your I's and crossing T's and having it buttoned, right? When you go in, whether you're talking to a VC or you're talking to a partner or a customer, or you're trying to close, a VP of marketing or sales or whatever else, you need to make sure that you build the confidence and you have the data to back it up. Right? You shouldn't just be sort of hand wave things over.
Yeah, very good point. So each of you have invested in tens, if not hundreds. And then, as you mentioned earlier, pattern recognition is like a big part, like after talking to so many founders, I wonder, Eric, if that also is valid for you. You kind of get a sense. So what are the 3 top things that when you see within the first few minutes of presentation, you're like, yeah, these are, I really have to pay attention. These have whatever it takes. Like if you really wanted to name top 3 qualifications.
So for us, since we are like technically oriented investors, normally these are not like college dropouts or like very fresh graduates. These are normally people who have had careers. And so the first thing is before they are even presenting, I do find past success is a good predictor of future success. So we're looking that when you did something in the past, you were successful. And so that doesn't have to be a startup, but it should be that you consistently took on more responsibilities, that every project you managed, that either it succeeded or you had a pretty good reason. You kind of understood why it went sideways and they've learned from it. So number 1 is that. Number 2 is that they were very thoughtful about constructing a team. We do find sometimes solo founders to be a little bit of a yellow flag, just because if you're really good, you should have found someone in your life that was so important to you and so good that you wanted to bring them with you. And they wanted to come with you because of their previous experience with you. And if you can't think of anyone or you don't think you need anybody, then it's like, I don't know. There's something off about that. And then the presentation itself is what I mentioned, that they have a good idea of managing the time and the information. And they tell a story first. It's not just, here's a great technology. It's like they know the format, which is, here's a problem that I'm trying to solve. And here's why it's so important. And here's why it wasn't solved before, because that's always a big suspicion. They want to anticipate why, like VCs will always ask, why you, why now? Like they need to anticipate that. Why are you special for this? And why wasn't this solved earlier? And then they know they thought through how they get to just the next step. I don't need to know 10 years from now, but like, how are you going to get to this next milestone? And then what happens that next milestone? If someone really can clearly articulate that and has those other prerequisites around their background and the team, then it's likely we're going to go further. We're going to deep dive on this.
So Manu, what is for you?
Yeah. So we look for the personality traits and we want to see, actually we always have preferred teams of 2 co-founders, right? One is too little, it's like raising a kid, 2 parents are better than 1. a single parent. If you have your mother-in-law also raising the kid, that's too much, right? So three and more is a crowd. So we like that focus. And the other part is, like we equate our CEOs to gardeners, right? As a good gardener, you need to make sure you're watering the right plants. And whether it's your past success, but you also are willing to take the weeds out if something is not working or someone is not working out. Do you have what it takes, right? Now if you started a company with your best friend or your brother or sister, would you be able to fire that person? Do you have what it takes? Because it's hard being a founder, and you have to make tough choices. So we're looking for those things. Intellectual honesty is a key part. If we ask for questions in the background and you sort of say, well, why was that failure? What happened? If you blame everything around you, well, it was the market, it was my VP of engineering that made me do this, or my CEO was an asshole, then let me do it. Whatever reason could be 10 different reasons. What we want to know is what was your fault? What could you have done better, right? If people who blame everything else around them will eventually blame me for something that happens down the road, right? And they will blame someone else. And so you want to take ownership of what you've done. You want to be able to figure out, have you learned from that mistake? Because if you blame everything else around you, you haven't learned. So we're looking for that learning mindset is a very important part for us.
Perfect. With that said, I have a couple more questions, but I'm going to open it to the audience. So if people on the Zoom, you have a question, please raise your hand. And people here in the room, I'm sorry, if you have any question, please go for it. Do we have any question here? Please. First, tell your name and then.
Yeah, my name is John Tippins. Is it okay if I ask a two-part question or just?
Go for it.
Okay. On the subject of warm intros, which you both spoke eloquently about, I frequently see requests for a blurb before the warm intro is made. So I'd like to, someone might say, I'd like to make a warm intro for you. Send over your blurb. Is there any information you would recommend? What should we put in the blurb? And then I have a specific question, which is how specific the information about where you are in your fundraising life cycle, like we are pre-seed raising at this valuation, or we are seed raising at this valuation. The second question was just, do you ever see a technical co-founder who's not the CEO pitching, or do you only see the CEO? That's the second question.
So I'll take, the second part first. The CEO should be the one pitching, right? You can have the if the CEO also happens to be a technical person, so be it. But you can't be the CEO unless you have that power, right? And so I think that's a bad sign if somebody else is running the show, but they're like, well, I'm really then I start asking questions of the cap table, right? It may be that you have the CEO because you don't want to do all the bullshit that comes along being a CEO, and you want to focus on the technical stuff, which is fine. But then you're not really the CEO, right? And I think that's a bad sign, because those things will always surface up later on. I don't know if Eric, you had anything to add to that, or?
No, I totally agree. The deep dive may include the CTO being on stage, or on stage, quote unquote. But I think the intro, if it's the CTO as the sole presenter, that's a bit strange. The CEO and the CTO coming for a pitch is pretty normal. Like I said, I think it's better to just have the CEO do it, but it's totally fine if the two of them tag team. The first question around the blurb, I think it's best practice to write a blurb. You don't want to ask people for warm intros and have them do all the work. And the blurb should include the basics. Like the first thing I want to know is this for me? So is it the right stage? So seed stage in this domain, whatever. It's also like, to the extent you're comfortable with that, if they can indicate how well they know you, if this person really knows you well, that's critical. Like, this is someone that I worked with closely, to the best person I ever met. They should write that themselves, ideally, but that is really important to say, hey, if you feel comfortable giving me a personal, like, one line that you know me really well, that would be great. In addition, here's my standard, like, here's what we do, here's where we are. But that one line that says, I know this guy really well, is actually meaningful.
Thank you.
I'll paste a couple examples of blurbs that we also then have to write a blurb to introduce our founders to new VCs, right? And so we actually spend a lot of time with our founders to sort of craft it properly, because it does make a difference, right? You want to be able to think of this as a teaser. You want to open up a door. You want them to take a meeting. You don't want to sort of give the entire thing away in the first meeting, introduction. but short enough that you're not wasting their time, but not too long that they will sort of put it away as a draft for later on, right? So I'll share one example.
Is it? Oh, so you shared it in chat. Okay.
Yeah.
I can copy it and paste it in the follow-up email. So one quick also thing I have seen, I don't know if you agree or not, is sometimes that blurb, the founders jump into too much technical details all of a sudden. Like you have like 5 lines and there are like 3 big words that not necessarily everybody familiar, but at the end of the day is how you're going to do it more than what you're going to do. So I think maybe focusing on what you're doing, just very easy to understand, because, you know, like how much really brain real estate do you have to go through that? You know, you want to read those 5 lines, 1 paragraph, and have a good understanding, is like as Eric was saying. So be careful of that, not make it too complicated or technical or details on how. And
I'm noting that Ripon Leo has had
yes,
his or her
exactly.
hand up for a little while.
Go for it. Yeah.
Yeah, thank you. Can you hear me?
Yeah.
Oh, thank you, Eric and Manu. It's a very insightful session, and it was also refreshing to hear that after all, it's a lot about human nature, human psychology, because after all, it's a partnership. It's not about, you know, throwing money and somehow it's going to be successful. My question is, I once went to a sharing session by Sequoia Partners, and they said, you know, the failure rate in VC is very high. You see about 2 stellar successes among a few small successes, and maybe 100 failures. And that's one end of the spectrum. And on the other end of the spectrum, for example, the value investing, which is a hyper conservative, and they you know, they value you load up once you discover an opportunity, when you identify the margin of safety. So there's 2 extreme end of the spectrum. I'm very curious to learn about how do you balance the quantity and the quality, even though the quality is very important. How do you balance those 2 when you are making the decisions for them, when you're going from sectors and then down to the opportunities?
Go ahead, Eric.
Yeah, so this is, well, the spread, the skew is correct. So it is a very, very strong power law in VC. And so each portfolio of ours is 50 companies per fund. And of those 50 companies, we expect that 3 are going to be quite big successes. And that has historically been our experience since 2010. Each of our funds had about 6% from seed to unicorn formation rate. But that may not be guaranteed for the future. In terms of like, how do we balance like quantity versus quality? We do have a bar, and we do have you know, way that we try to, you know, we have 4 partners on the IC, and you want to have someone who feels very strongly about it. And so we have a voting system that we rely on, and certain kinds of things we're looking for. But having said that, I think we all accept a lot of risk. We're not trying to have 100% hit rate. We're trying to see that any of these companies have the ability to become really big. The thing that most seed stage VCs will not invest in, at least within my strategy and probably Manu's strategy as well, is a company that can never have a big exit, but has a relatively high percentage chance of having a 2x or 3x. Most seed funds are not interested. That's a different business, and it's not normal for most VCs.
Yeah, 100%. Yeah, so yeah, I mean, even our pitch deck to our LPs is all about, you know, power law, right? You know, we respect the power law. You have to build your engines around power law. How do you identify companies early on? You know, now you're going to make mistakes. You know, it's like 1 in 10 or 1 in 12, whatever number it happens to be. But it is power law completely, and this is not for the faint of heart, right? And so you need to be good at doing this. Everything from sourcing. If you pick a wrong company, it doesn't matter how much time you spend. It's not going to return anything back, right? And so a big part of what we do is, you know, from as you sort of find your early losses, right? You need to sort of put your energy and your resources into the companies that do well. So big change. It took me about 3-4 years to learn this. I mean, I'm a little bit slower than Eric, but you know, it took me a while, because you can't treat your startups like your kids, right? Like if you have 2 kids and one kid is falling behind, like, you know, one went to Harvard, the other one's a drug addict, on average, they're okay, right? But it doesn't work that way. And so you're spending more of your time actually helping the second kid who's falling behind. In this world, you need to focus more of your energy on the one that's doing well, because any improvement there will make up all the losses that you have on the other side, right? So give you an example, one of our companies, we went public 2.5 years ago, Poshmark. We put 30 times more capital to work there than the initial check, right? So, and that company returned just by itself, returned the entire fund by 5 times, right? So we look at return, we call it RTF, return of fund potential. So when we do a new investment, I have to convince my partners, what is the potential for this to return the fund? I actually don't even care if it's a unicorn, because most of our funds, I mean, if you have a smaller fund, it's a $50 million fund, I owned 10% of a company, I'd have $500 million that returned the entire fund back, right? Now, if I'm a $2 billion Andreessen Horowitz fund, well, even if I own 20% of a company, my exit just to return the fund back needs to be over 10 billion, right? And so those numbers become really different as you go up to the later stage companies, right? And so they can't accept a high fail rate. They're okay with lower returns, right? So it's a very different game you play at the later stage than what Eric and I play. For me, it's all about multiples. If I don't have a 100x multiple in each of my funds, at least one startup, you end up in the wrong side of the equation.
I want to say goodbye. This is great. I have to hard stop though, and so I have to jump.
Thank you so much.
Sarah, thank you so much for organizing. It's good to see you as always.
Thank you so much for making time. I really appreciate it.
No, this is great.
Happy
always great. Thank you.
Okay, thank you.
Bye.
And thank you everybody for joining online. We have to leave this room also on time. So look forward to having you. If you can join the next week's session, hopefully from Berlin, that would be a pleasure. Otherwise, stay tuned for our sessions next year.
Thank you. Thanks for having me.